So some quick math, if Bitcoin captures just 1% of global assets, just 1%, that's a $10 trillion valuation, or a 5x from here, without requiring retail FOMO. But for the bold, adding 10% of Bitcoin to your portfolio quadruples your return to 495%. This is the elephant in the room. What do we do when there's no safe asset sleeve? So this chart tracks 30 years of institutional portfolio evolution. Because the open secret is that the system doesn't just tax your income, it taxes your savings. Since early 2015, the Bitcoin held across major institutional and custodial entities have surged to 6.2 million BTC, or an increase of 924%. So we arrive at the real question: what do you own when everything inside the system is either inflated, illiquid, or guaranteed to lose value in real terms? Good afternoon. Everybody doing all right? So as Anders said, I'm James Lavish, and I'm the co-managing partner of the Bitcoin Opportunity Fund. And I've been an institutional investor for over 30 years now. It pains me to say that, but one thing I've learned, being in hedge funds and arbitrage and Bitcoin, and now macro and Bitcoin strategy, I've learned one thing above all, is that capital always follows incentive. And today we're watching those incentives change. They're shifting right under our feet. So what we're going to talk about today is why Bitcoin is not just an asset class, but it's an inevitability. Not because it's trendy, not because it's digital gold, but because it's a natural response to a financial system that's reaching the limits of its own design. So let's start with a simple question. So what happens when the asset that you built your entire portfolio on, your ballast, stops working? For decades, the 10-year US Treasury was the world's safest asset. It hedged against drawdowns, and it paid real yield. It helped you meet your liabilities. Today, it correlates with equities. It yields less than inflation, as measured by the expansion of the money supply, and it adds volatility, not stability. This isn't policy error. This is the policy. The tool the government uses to suppress real yields and real rates to manage all that unsustainable debt it has. Many of you have heard me talk about the debt spiral, the debt problems ad nauseum. We won't go too deep into that, but it does help to understand why this is all a big problem. Anyway, so the result is that cash and bonds are no longer safe. The tool, right, that they're using, it's making them melt the real yields. They're melting in real terms, quietly, systemically. And now that the base layer is broken, then everything that's built on it is at risk. And that risk grows every single day. So in short, the discipline has been replaced by debt dependency. The global economy is now addicted to what's called credit expansion. A friend of mine, Michael Howell, writes all about this, liquidity, how liquidity drives all the markets, and the expansion and contraction of liquidity is really important there. It's really the underpinning of all of it. So, but the bottom line is that the global economy is driven by this debt, which is now $324 trillion in the first quarter of 2025. Right here in the US, we're spending over $1 trillion annually just on interest on our federal debt. That's more than defense. It's more than Medicare. And sovereigns can no longer afford neutral interest rates, let alone restrictive ones. And so the response from central banks is to deleverage, to increase liquidity, to do more QE, to ease collateral terms, to rescue the market again and again. Okay, so what do I mean by easing collateral terms? Later today, the US Fed is going to vote on something called the SLR, the supplemental leverage ratio. Really fancy term, but what it means is that they're going to remove US Treasuries from the calculation that banks use on their liabilities. What does that mean? That means that the banks can now buy US Treasuries ad infinitum, as many as the US government needs to sell them, and they'll make money off of it, off the spread. It's mental. So why is this? It's because we've reached fiscal dominance, where the government spending is necessary to drive the economy. So therefore, monetary policy now exists to fund government obligations. This is no longer a cycle, it's a regime. We're in a permanently low rate, high liquidity world where, because it's optimal, but it's the only path left. It's not optimal, it's the only path left. And as my good friend Lynn Alden likes to say, nothing stops this train. So let's get something straight here, let's something clear. Negative real yields aren't a fluke. They're not an error. They're not some post-pandemic anomaly. They're policy. A deliberate feature of the system that's addicted to debt and growth at any cost. So the playbook is simple. The governments rack up unsustainable debt. They can't inflate it away overnight, so they suppress the real yields. They pay the bondholders less than inflation and let time do the dirty work. They print money, make dollars worth less, pay back the debt with cheaper dollars. It's super simple. And this isn't a fringe theory. The IMF calls it a subtle form of wealth taxation. The IMF itself admits it. And it works beautifully, as long as nobody notices, as long as the people don't protest, as long as allocators just go along with the scheme. Okay, so what are we looking at here? We're looking at the growth of all the liquidity and the money supply across the world. So why do they have to repress rates in the first place? Why are real yields negative? It's because it doesn't work, the system doesn't work without more liquidity. With debt loads so high, the only way out is inflation and money creation. And make no mistake, without more liquidity, the system will simply collapse on itself. And so this chart shows that global money supply growth since 2000. You could see that the acceleration in 2008, and then it goes vertical in 2020, where we're adding over 7% per year of money supply, compounded to the global supply. Remember that number. We're going to talk about it in a minute. And here we see in the US how the US Federal Reserve balance sheet grows lockstep with federal debt. That's not an error. That's not a mistake. It's purposeful. That's what we mean by when we say irresponsibility demands liquidity. More debt, more printing. More bailouts, more printing. More fiscal spending, more printing. And if you know that, you also know this: the purchasing power of fiat is structurally designed to decline. All right, let's get into the good stuff about institutional investing. Because the open secret is that the system doesn't just tax your income, it taxes your savings, quietly, relentlessly, systemically. And this ultimately, it breaks the traditional model. Bonds don't hedge, cash doesn't preserve, the anchor asset becomes a liability. That's the problem for investors, for professional investors, for individual investors, for retail investors. Everybody has the same problem. And the old safe haven playbook is obsolete. You need assets that sit outside of this repression loop. So you have to rethink what safe even means. Which brings us to the obvious question: what do you own when everything denominated in fiat is quietly melting away? That's the question that these portfolio managers have to face every day. All right, so this is the elephant in the room. What do we do? What do we do when there's no safe asset sleeve? So this chart tracks 30 years of institutional portfolio evolution. In 1994, 85% of the capital sat in fixed income. By 2022, that number dropped to 4%. Why? Because safe no longer meant productive. Bonds don't hedge, they don't preserve wealth, they don't meet future liabilities. With negative real yields and suppressed coupons, they become an anchor that drags your returns down, not a risk buffer. And so what happens? You're forced to reach as an investor, and I've lived this, you're forced to reach into illiquid assets, into private deals, into derivatives and leverage. You build complexity into your portfolios. You increase the duration. You add tracking error, all to chase that same 7% nominal yield across the board. In a world where, remember that number? The global money supply is expanding at the same rate, 7%. Same return target, triple the risk, zero real return. And complexity and risk are doing all the work. Portfolio managers are simply hamsters on a treadmill, and we all know it's unsustainable. So we arrive at the real question: what do you own when everything inside the system is either inflated, illiquid, or guaranteed to lose value in real terms? And that's where we begin to shift, not into speculation, but into design-fit assets. Assets built for this very problem. And that brings us to the institutional mindset, because it's not easy for institutions. I know it, I've lived it. They can't simply shift their mindset and adopt a new strategy. So Bitcoin maxis like to call these guys dinosaurs. But in reality, institutions are more like massive ocean liners, programmed for a destination. And the captain, if he wants to change and go into a different path, the portfolio manager, to that same destination, he has to ask permission from a dozen superiors in a rigid chain of command that looks kind of like this. And so people like to say that institutions are late, but let's be clear, they're not slow because they're dumb. They're slow because they're structured to be slow. It's purposeful. And the job of the pension CEO isn't to chase alpha, it's to meet intergenerational liabilities through consistent, defensible process. They have to defend it themselves. They have to be able to defend it to their superiors that they're doing the right thing. And every single decision that's accountable to boards, consultants, stakeholders, and as we've even seen, politicians. And this is the capital pipeline, what a new asset must pass through to get into a portfolio. Actually, just even to be considered. So you have industry research, asset class review, due diligence, committee vetting, board approval, policy documentation, ongoing risk management. Oh, it's so difficult just to get something into a portfolio. It takes months, sometimes years, even to reach a decision. Mind-numbing, but why? Because of ALM, asset liability management, the institutional North Star. It's what they're all looking towards. You have to match long-term obligations with your asset performance, the volatility and liquidity. And new asset must improve the portfolio's ability to meet these future liabilities. And if it doesn't, it's DOA, dead on arrival. So even when a CEO sees and understands a thesis like Bitcoin, he has conviction or she has conviction, he still needs the model inclusion, consultant endorsement, governance sign-off. And probably one of the biggest parts is they need reputational cover. And that's why Bitcoin hasn't flooded into portfolios yet. Not only because it's misunderstood, but because it's had to fight its way through that institutional process. That's changing now. We're all seeing it slowly, but it's really changing. And now Bitcoin is winning institutions over and earning an allocation into portfolios. And once it's in, It doesn't leave. Remember that, because now it's policy. So institutions don't fear volatility. They price it. What they fear is being the outlier, the CIO who bought Bitcoin and got crushed in one of these drawdowns. Even if the math was solid, even if they thought they could defend it. But this is why ideas like Bitcoin take so long to break through. After all, as Keynes put it, it's better for reputation to fail conventionally than to succeed unconventionally. And so they wait, they watch. They need a bridge. And so what finally is getting them off the sidelines? You all know this. Up to last year, Bitcoin faced significant structural barriers. Really difficult to get into a portfolio for a institutional manager. You had ALM, you had committee reviews, we talked about this, fiduciary optics, and all of that kept Bitcoin outside. Well, this all changed with the introduction of the spot Bitcoin ETFs. Once the ETFs came and Bitcoin got the ETF structure, once it was custodied by BlackRock and Fidelity, traded on the New York Stock Exchange, got the nod of approval from the SEC, and it cleared institutional compliance, it crossed that institutional investing Rubicon. It became normalized. It became allocatable. And now that that bridge exists, institutions are ready to cross it, and they're already doing it. And just look at what happened with IBIT. When BlackRock, Fidelity, Bitwise, and others launched their ETFs, it wasn't about convenience, it was about giving permission. Now a CIO can walk into a boardroom and say, this isn't a fringe product anymore, it isn't a fringe trade, it's a compliant product from some of the world's largest asset managers. It trades on the New York Stock Exchange, it gets settled with it, it's held by the same prime brokers, it's easy for them to own now. And so it didn't become investable when it hit $50,000 or $100,000. It became investable when it hit the institutional compliance stack. And it's no surprise then that IBIT, BlackRock Spot ETF, became the fastest growing ETF in history, reaching $70 billion in just over a year, 5 times faster than GLD, the gold ETF, which was the previous record holder. So this isn't speculative money. It's fiduciary capital that's finally been given the green light. Institutions are now learning that Bitcoin is not just digital gold. It's monetary architecture built for a world of endless mistrust, constant overreach, and oppressive inflation. It has no central issuer, no credit risk, no dilution. You all know all this. Its monetary policy is embedded in the code. Only 21 million will ever be issued, full stop. It clears 24/7. It's borderless, programmable, and it's neutral. And in a multipolar world where sovereigns are questioning the dollar system and seeking neutral reserves, Bitcoin is the first digital asset that offers true and trustless neutrality. It's simple. Bitcoin already trades over $50 billion a day. It settles in real time. It's got full public ledger transparency. I'm preaching to the choir, I know that. But Bitcoin is the only uncorrelated global liquid hard-capped asset that exists. That alone earns it a spot in your portfolio. If you're an institutional investor out there and you're listening to this, it earns a spot because of those things with what's going on in the world. So let's take a peek what happens when you do add it. What we're looking at here is a traditional 60-40 portfolio, the blue line at the bottom. Okay, and that's 60% stocks and 40% bonds. Over the past decade, that returned 127%. Not too bad. Annualized rate of 8.5%. Okay, remember what we said the hurdle rate is? 7%. So it's not that great. You only get just over 1.5% of above that neutral rate. So replacing just 1% of the bond portfolio, the bond side of this, it boosts your return to 153% and 9.7% annualized. Okay, better. Adding 5% Bitcoin and taking it out of the bond portfolio to do that doubles your return to 275%. 14.1% annualized, even better. But for the bold adding 10% of Bitcoin to your portfolio quadruples your return to 495% and a whopping 19.5% annualized rate. Thank you to Bitwise for the model that they've allowed us to use for this. But if that doesn't convince you, get this, your Sharpe ratio, which is your risk-adjusted return, it goes up with each amount of Bitcoin that you add to your portfolio. And with 10%, you jump over that magic asset allocator number, which is 1.0. If you get over a 1.0 Sharpe ratio, it's easy to defend. So think about that, though. 5% Bitcoin allocation, no leverage, no derivatives, doubles your return and significantly improves the risk-adjusted return. Then 10% just kicks it up even further. For any allocator, managing volatility or tracking error, that's not just compelling, it's portfolio engineering. It's not just about betting on Bitcoin now, it's about using it as a convex payoff in a world where traditional assets are delivering linear risk and negative real return. Many of you have seen this chart before. Jesse Myers lays it out clearly. The global investable assets are now over $1 quadrillion. And so, yeah, Bitcoin's the smallest one on there. But gold has been around for thousands of years, and Bitcoin is already a tenth of its size in just 15 years. So some quick math, if Bitcoin captures just 1% of global assets, just 1%, that's a $10 trillion valuation, or a 5x from here, without requiring retail FOMO. And the first institution to allocate, well, they're not looking for validation. They're positioning for scale. So in a report from Gemini and Glassnode, just this last week, they found that over 30% of Bitcoin's circulating supply is now held by just 260 centralized entities. So this points to directly deepening custodial centralization. What does that mean? It means institutional adoption. And so since early 2015, the Bitcoin held across major institutional and custodial entities have surged to 6.2 million BTC, or an increase of 924%. Look, most institutional managers, they manage multi-generational capital. They don't chase trends, but they all share in the same pressures: duration, mismatch, underperformance, and currency concentration. So this chart, this shows the different reasons that asset allocators are investing in Bitcoin. And of some of the questions they've asked, are you investing it because of duration, or because of speculation, or because of diversification? The blue line is diversification, the black line is speculation. So diversification has emerged as a top reason for investing, overtaking speculation recently. So despite the common belief that speculation is the main driver, it now ranks third or fourth as the most cited reason, often coming in below client demand and diversification. So as fiduciaries, institutions are forced to ask the question, what assets survive if trust in the sovereign money continues to erode? Bitcoin doesn't need a 50% allocation, it just needs 1% from the right players. Because when they allocate, they don't sell, they just rebalance, they normalize it. Bottom line, Bitcoin is the default escape valve, not a rebellion, a refuge. And it'll soon become the pillar asset that portfolios are built around, not the US Treasury, not the 10-year Treasury, it will be Bitcoin. And we're witnessing a quiet institutional adoption. Again, not through hype, but through structure, through process, through the risk models and due diligence and those memos, through all of that. And that's what makes this moment so powerful. Bitcoin isn't being pushed, it's being pulled by the same system that once dismissed it, laughed at it, attacked it. You've seen what's broken. You've heard and been shown the exit. You now see it. The infrastructure is built, the capital is moving, and now you have a choice. You don't need to believe in Bitcoin. You just need to believe in math. Thank you.